Good morning, it's Jeff Christian. It's about 10:35 on Friday, the 25th of June. Coming to you from New York. I hope your weather is as pleasant as ours is. The title of my talk today is The Fundamentals Still Apply, and got a lot of ground I want to cover, so I'll try to be succinct. Last week, I started the video with a tale from Chuang Tzu, who was Lao Tzu's disciple. And I want to start this week's video with a quote from Rick Blaine, or a reference to Rick Blaine, who was Humphrey Bogart's character in the movie Casablanca. And of course, the line, "The fundamentals still apply," comes from the song As Time Goes By, which was the famous theme to Casablanca. In the very beginning of that movie, they're setting the stage and they're introducing you to the various players and their characters. And they go around Rick's Cafe Americain. And there's one scene where a fellow wants to get into the VIP back room where there's gambling and the VIPs gather. And Humphrey Bogart's character rejects his entry at the door. Guy gives him his business card. He looks at it, he tears it up, and the fellow says, "This is an outrage. Deutsche Bank is recognized and accepted everywhere." And Rick Blaine, you can see Nazis gambling in the back room behind Humphrey Bogart. So he's letting Nazi officers in, but he's not letting a Deutsche Bank banker in, which is kind of interesting. Obviously, Deutsche Bank was the bank, one of the primary financiers of the Nazi party and regime. It also, I don't know that it's ever been revealed, but it also took a lot of its profits and bought freedom for a lot of Jewish people, that it bought passage out of Germany for them. So it was very duplicitous, is there. Now, the fundamentals still apply. I've actually used this title twice. There was a conference for the Mineral Economics and Metals Society, which is a subset of the Society of Mining Engineers. And I gave a talk in the mid-90s, which appears to be lost to history, called The Fundamentals Still Apply. And I talked about how it really was fundamentals that gives you the basis for understanding these markets. And part of the problem at that time, and still today, is that people don't understand investment demand. And back then, they actually excluded investment demand, not only from their supply-demand balance, as they should, but also from their analyses. And we were making the point in the mid-1990s, as we always have, that investment demand, changes and directions and levels of investment demand are the key factor determining gold and silver prices, levels and directions and momentum. So that if you were looking at supply and demand, which many people did, supply and fabrication demand, but not taking into consideration trends in investment demand, you would get your price projections wrong all the time. We already had 14, 15-year record of calling the markets extremely accurately, oftentimes at variance to the market consensus, buying low, selling high. So we already had a reputation. We said, it's not that the fundamentals don't affect the price, it's that you're misdefining fundamentals. I used the title a second time, and apologize for the quality of that cover. Jay Wiley and company published Commodities Rising in 2006. I had nothing to do with the quality of printing on the cover, but the summary chapter of Commodities Rising, which is why I put it here, I titled The Fundamentals Still Apply. And it was a summation of how investors could profit in the commodities market, even in the face of what was then all of the marketing hype about the commodities super cycle. And that book, part of that book's importance was that it said commodities super cycle is nothing but marketing hype. This is economics 101 that is driving commodity prices higher. And you have to do your basic economics. And if you do your basic economics properly and dispassionately and objectively, you can actually use the fundamentals and the macroeconomic environment to call that up. It came to mind because over the last several months, we've had many investors say, what's a good primer for me to read about commodities investing. And there aren't a lot of good ones. There are a lot of bad ones. It's sort of like processed food. But that book was written in 2005. Jay Wiley came to us and said, Jeff, we want you to buy this book. I said, why? And they said, and I may have given you this anecdote last week. I said, they said, there's a fellow who's written a book called Hot Commodities. And there are two things you have to know about hot commodities. A, it's a bestseller, and B, it's full of errors. So we were sitting around our editors meeting saying, look, so obviously there's demand for books from investors, there's a demand from investors for books on how to invest wisely in commodities. Who do we get to hire, write it? And somebody said Jeff Christian. So Wiley came to us, commissioned me to write that book, and also actually took over publication of the gold, silver, and platinum group metals yearbooks, which were titled surveys at the time. They changed the title to yearbook, or asked us to change the title to yearbook. And they were publishing our yearbooks for a few years. They did a terrible job on it. And so we took over control of publishing and became the de facto publishers. So the title, The Fundamentals Still Apply, goes directly to the heart of what I want to talk about. Now, I actually have three broad areas that I want to talk about. And I'll try not to go too long, although I've already gone longer than I probably should have. The first one is understanding investment demand and the differences between investment demand and fabrication demand. I have talked about this recently in last week's video. I've written about it for years, decades actually, but we also gave an interview to Kitco this week and to SOAR Financial. And both of those interviews are very good and interesting and worth finding on YouTube or at Kitco because they really got into, let's talk about the fundamentals, let's talk about how research is done, let's talk about the differences between investment demand and fabrication demand. And there are very big differences, and there are several reasons why you distinguish between investment demand and fabrication demand, and why if you're doing real research as opposed to marketing, you do not include investment demand in your supply demand fundamentals. And as I said, prior to the mid-1990s, no one did. They didn't even look at investment demand, which was really shocking to us because working on Wall Street, we sort of said, that's where it all starts. It's all financial to really get to the core of it. Now, investment demand you exclude because, as I've said last week, you really want to understand a market and you really want to be interested in investing in markets that have a deficit of total newly refined metal entering the market relative to fabrication demand. Some people now call that a primary deficit because they include investment demand in with fabrication demand in other parts of their reports. But it really is a deficit as defined by Commodities Research 101. You want to find a commodity that fabricators are using more metal than is being refined from mine production and secondary recovery, because that's a really bullish market. If you find a metal that is in a deficit because fabrication demand and investment demand are buying more than is being newly refined, so you're drawing down it's less bullish. And most informed investors do not want to invest in a commodity the price of which is rising because other investors are piling into the market. They want to find a commodity that the price is rising because fabricators, who are much less price elastic than investors and less quixotic, are buying more than is being refined. So you're actually drawing down, if you will, the capital stock of above ground refined inventories if you have fabrication demand greater than total new supply. So the first reason why you segregate the two is because of the desire to really find markets that are in real deficits of fabrication, of total newly refined supply to fabrication demand. The second thing I alluded to in why you disaggregate investment demand is it's very quixotic, it's very price elastic. Investors do not change the form. If you're buying copper and you see a primary deficit, and that copper is being used in motors and plumbing and electrical wiring and things, that copper is changing its essence, and it's not readily saleable as refined copper. If you're investing in copper and you find that the market's in a deficit because investors are buying copper and putting it in a warehouse, that copper can come back to the market at a moment's notice. And investors are notoriously quixotic. There are many investors who seem compelled to buy high and sell low. So you have a much less secure investment if you're investing in a market that is in a deficit because people have added investment demand figures in there. Also, investment demand is inherently more difficult to estimate than fabrication demand. So there are a whole bunch of reasons why you disaggregate it. It's not that investment demand is not important to the price formation. It's not, it's that it's radically, fundamentally different than fabrication demand. And as I said, investment demand is the primary factor that we look at in determining our price outlooks for gold and silver, and it has always been. People will sometimes say to us, so you think that investment demand is now becoming important to the price? And our answer is no. We've always thought that investment demand was important to the price, and it still is. The fundamentals still apply. And if you get your fundamental research properly done, then you can actually do better than the market consensus in this market. The second thing I wanted to talk about is Basel III. And I want to talk about it because it's not important. There has been so much chatter on the internet and elsewhere about Basel III and how it's going to destroy the gold bullion trading market, and the bullion banks are going to get out of bullion trading, and it's going to, double the cost and make it prohibitive to provide financial services for gold mining companies, smelters, refiners, and fabricators, and wholesalers and retailers of investment products. That's not the case. Basel III is important to gold and silver, and I'll talk about that in a second. You can see the bullet here if you want to read ahead. The banks don't like the idea that certain requirements under Basel III are going to increase the cost. They are not increasing the cost of doing the banking prohibitively. They are increasing the costs, ergo reducing the profits initially of being a bullion banker or dealer. That's actually, that's a key thing. The Basel III applies to banks. It doesn't apply to non-bank financial institutions like dealing companies, investment banks, and insurance companies that have commodities trading desks. It doesn't affect non-bank financial institutions. So it may cause a skew in the relative competitiveness of non-bank institutions relative to nationally chartered banks. The banks have taken this into account. They have made adjustments to their liquidity programs and their reserve requirement programs, and they're okay. Basel III, of course, comes into effect on Monday in the EU, the European Union. It comes into effect on July 1st, which is Thursday in the United States, and it comes into effect in January of 2022, I believe, in the UK, now that it's left the European Union. But the steps have been taken to meet those requirements. So insofar as Basel III requires increased reserves up against unallocated gold on banks' balance sheets, there'll be no hiccups, there'll be no ripples. There should be no price effect from the actual implementation of Basel III, either Monday in the EU or in January next year when it comes into effect in the UK, which is where a lot of the gold is stored, but it has to do with where the banks are actually registered and chartered. There should be no hiccup in the price from that. There could be some waves caused in the gold price because other people might buy or sell gold in the expectation that Basel III could cause hiccups in the bullion banking area. But those would be short-lived and relatively brief. And yeah, there are a lot of carnival barkers who are going around talking about how Basel III is going to destroy the gold market and the price is going to rise. And this is the end of bullion banking as we've known it for 5,000, 6,000 years, et cetera, et cetera. Not going to happen. And I show you something, I'll just jump ahead. Here's the London Bank vault holdings. You can see, yeah, they came down a little bit and they're back up, and they are higher than they have been since any time prior to the middle of last year. And again, about 500 million ounces of that, I was thinking about the silver. A significant portion of this gold is actually unallocated. So there's plenty of gold in London to meet these reserve requirements. Related but different, there's been a lot of chatter about the increased gold dollar swaps that the Bank for International Settlements, the BIS, has been doing. And the BIS is the bank of central bankers. So the BIS does these gold swaps with central banks, but the central banks are doing them as pass-throughs for commercial banks in their jurisdictions. And you know this because if you look at the gold balance sheets of those central banks that are doing these dollar gold swaps, they're not changing. So this is not central bank gold that's being swapped out for dollars. It is actually commercial unallocated gold that is being swapped out for dollars. And you're doing, the banks are doing that, and you can see, you know, well, this whole long period from 1982 until really 2008, 2009, there were very few of these done. And most of this gold actually is owned by the Bank for International Settlement as part of the value of the shares that the central banks that own the BIS put up in order to be part of the BIS. And this is relatively stable. In the financial crisis, there were a lot of dollar gold swaps, and then it came down, it was liquidated, and then 2016, 2017, they came back up, they were liquidated again, and there's been a big increase here. And the important thing, we've seen some bad information. Well, why do you do dollar gold swaps? You do it because you have a dollar liquidity issue. It's not a matter of having a gold liquidity issue. You have gold and unallocated accounts that you're holding, and you have that as part of your assets and part of your liabilities and part of your reserves. But you need dollars, and you need dollars for your liquidity ratios, you need dollars for your reserve ratios, you need dollars to finance your business. You're a bank, so most of what you do is dollar denominated transactions and other currencies, but mostly dollars. So you need dollars to meet your liquidity ratios, your reserve ratios. So what you do is you go to your central bank and you do say, I want to do a swap. Now, you know, central bank says, that's great. We'll arrange it with the BIS. So it's a pass-through. We will swap you dollars for your gold, unallocated gold. And then we turn around as a central bank and we do a dollar gold swap with the BIS. The BIS holds that gold on its account while these swaps are in effect. The dollars go to the national central bank and then on to the commercial banks. And it's very funny because there are people who are speculating, oh, well, you do these gold swaps, you do these gold swaps because you need liquidity. Well, that must be, what kind of liquidity you need? Oh, the London banking industry must be in really bad shape and it needs gold liquidity. Or maybe they're lending this gold onto CME, people who are trading on the COMEX. No, it's not gold liquidity that's causing banks to do gold dollar swaps. It's dollar liquidity. Now, That's much more important to the gold price than any kind of nonsense about needing gold liquidity or Basel III. One of the questions that we've answered repeatedly over the last several months is, why are banking regulators implementing Basel III at this time? They, came up with the concept. They started talking about it in 2009, and they have delayed implementation of various parts of Basel III several times over the subsequent years. Why are they doing it now? And the answer is that banking regulators are looking at banking industry stability. They're looking at how they had to bail these guys out in 2008 and bailed them out in an extremely inefficient and poor way that actually shook the foundations of capitalist democracies. And they're saying, we don't want to be in a situation of bailing these guys out again. So we're going to actually step up, sit up straight, and do a better job of regulating them. And we're passing rules to increase their liquidity and increase their reserves so that when future financial crises occur, the banks are in better shape to weather the storms. And it's very important. The bank regulators are saying, banks today in 2021, you need to get your reserves and liquidity in order to protect yourselves and the economies you serve and the nations you serve from future financial crises. They're saying, let's do this now. No more delays. Why are the bank dollar gold swaps doing? Because the banks need dollars to increase their liquidity. The fact that the banking regulators are choosing now to put these things in place is much more important to gold and silver price outlook than the idea of the increased costs. The increased costs that banks have will be passed on to their customers the way they pass on all of their costs. What's really important is the fact that the regulators are saying, it's 2021. We've just been through 2020. We need to get our banking industry in order to provide the hopes that we have stability. And that is much more important for gold than silver. The third thing I wanted to talk about briefly is platinum group metals. We will be coming out with our platinum group metals yearbook on the 13th of July. We're working on it right now. There's a tremendous amount of information in there about the auto market, shifts in the nature of the auto markets away from diesel to gasoline vehicles in Europe and in India, the two big diesel markets, shifts away from ICE and diesel engines that burn petroleum products toward electric vehicles or hybrid vehicles, or what their Europeans are calling alternate fuel vehicles. There are major shifts that are starting to emerge now, and that will become more intense over the next 10 or 20 years. And there's a lot of discussion about what that means for PGMs. Obviously, if you're not burning fossil fuels, you don't need PGMs in your vehicles. But if you're not burning fossil fuels in the engines, where are you burning the fossil fuels to get the electricity for those electric vehicles, which is a whole nother issue. And there are all kinds of other issues, and there's fuel cells, which really don't make economic or technical sense for most on-road vehicles. They do make sense for bus fleets and warehouse forklift fleets and other places where you have a fleet manager, but they don't make a lot of sense for passenger vehicles. So you have other people looking at a variety of things. Battery-powered electric vehicles and hybrid electric vehicles seem to be the two places where people are putting a lot of their money right now. And we wouldn't be surprised if those are transition technologies in terms of mode of transportation, but that's a long-term issue. The Platinum Yearbook's coming out. And in addition to all of the auto changes that are occurring, the platinum and palladium and rhodium markets have become much more volatile, as have the iridium and ruthenium. We have like 2 or 3 pages of iridium and ruthenium discussion at the back of the yearbook. Most of it's platinum, palladium, and rhodium. And there have been some enormous changes and increased volatilities in all of these markets. And as with gold and silver, there's a lot of marketing stuff that's put out by producers or their agents that don't necessarily represent accurate portrayal of the PGM markets. And the industry knows that. The South African government has created a private-public partnership looking at the PGM markets and looking at how they got into the state that they're in and what the future holds and what the government and private entities within South Africa ought to be doing to position themselves to weather future storms and to profit from future changes in supply and demand in PGMs. CPM Group has been an advisor to this private-public partnership effort in trying to provide really accurate data on supply and demand, because there's a lot of stuff out there that's not particularly accurate. And there's a lot of times when people see metal sloshing around the market and they either say, well, that must be the Russian government, or more likely in recent years, oh, that must be investment demand. So there's some pretty spurious data out there. I'll just give you one point. Yeah, there's one company that says that the rhodium market, which has been in deficits for most of the last 40 years, will continue to be in large deficits. And they have a cumulative deficit over the next 5 years or so of like 500,000 ounces. Now, deficits can only exist if there are above ground inventories to accommodate that shortfall of newly refined metal. Again, I've talked in the past about the difference between, say, a current account of supply and demand versus a capital account of above ground inventories. And there isn't 500,000 ounces of rhodium left in above ground inventories to accommodate that kind of deficit on a persistent basis for rhodium. Rhodium prices have gone from $3,000 in the middle, in early part, even in the middle part. I mean, in August of 2019, rhodium was $3,000. It got to $29,800 earlier this year. It's backed off from that. But you know, the rhodium market imbalance is being resolved by changes in supply and demand, and probably statistically cannot be resolved by continuing drawing down capital stocks of refined above ground inventories that do not seem to exist anymore. So we've got that platinum yearbook coming up right now. You can pre-order it on our website. You can order the gold and silver yearbooks. We don't sell Commodities Rising, but you can buy a Kindle version and probably hard bound versions on Amazon.com. It'd be interesting. I'm sure I'll never see any royalties from it. Thank you. Have a good weekend. Take care. Enjoy the summer if you're in the Northern Hemisphere. Enjoy the early winter if you're in the Southern Hemisphere. And we'll talk to you next Friday.